They are the girls from Springs Girls High School with their educator, Miss Rachel Masaza, and the deputy principal, Miss Heather Jones. Congratulations and welcome. Let's get to the business of today. The UK vote to leave the European Union has dominated the global landscape in the past month. The outlook for the global economy has become more uncertain as the potential consequences of these developments are being assessed. The lack of clarity regarding the process going forward has had significant implications for global growth and interest rates as the prospects for further near-term monetary policy tightening by the US Fed recede. While there has been spillovers to the South African financial markets, particularly the exchange rate, the direct short-term impact on the South African growth and trade is likely to be fairly limited. Domestic growth has surprised further on the downside, and the outlook remains constrained. At the same time, domestic inflation outcomes have surprised marginally on the downside, but an extended breach of the target is still expected. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas, moderated to 6.1% in May before rising to 6.3% in June. Food price inflation measured 11% in June, below the recent peak of 11.3% in April, and was marginally negative on a month-on-month basis. Goods price inflation measured 6.7%, up from 6.6% in May, while services increased by 5.8%, up from 5.7% in May. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 5.6%, up from 5.5% previously. Producer price inflation for final manufactured goods continued its downward trend, declining from 7% in April to 6.5% in May, mainly due to a further moderation in price inflation of food, beverages, and tobacco products. This was below the consensus forecast of 6.9%. The impact of the drought is still evident in the increase in prices of agricultural products, particularly cereals and other crops, as well as live animals and animal products. The latest inflation forecast of the bank shows a marginal improvement compared with the previous forecast. Nevertheless, inflation is still expected to accelerate further this year and is only expected to return within the target range of 3 to 6% during the third quarter of 2017. Inflation is now expected to average 6.6% in 2016 and 6% in 2017, compared with 6.7% and 6.2% previously. In 2018, inflation is expected to average 5.5%, marginally up from the previous forecast. The expected peak at 7.1% in the fourth quarter of 2016 is down from 7.3%. The downward revisions are due in part to lower administered price inflation, despite a small upward adjustment in the international oil price assumption. The forecast for core inflation is lower than the previous forecast in the near term, mainly due to the lower starting point, but higher in the outer period. Core inflation is expected to moderate from an average of 5.8% in 2016 to 5.3% by 2018. Whereas previously, core inflation was expected to breach the upper end of the target range in the third quarter of 2016 for 4 consecutive quarters, a one-quarter breach at 6.1% is now expected in the fourth quarter of this year. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research, remained relatively anchored at the upper end of the inflation target range. The second quarter average expectations for 2016 were 6.3%, up from 6.2%. Average expectations for 2017 were unchanged at 6.2% and were marginally down to 5.9% for 2018. Expectations of business people were more or less unchanged compared to the previous quarter. Both analysts and trade union officials revised up their near-term forecasts, while forecasts for 2018 were revised lower. Average 5-year inflation expectations declined from 6.1% to 5.9% in the second quarter, with downward revisions by all groups. The median expectations of market analysts, as reflected in the Reuters Econometer survey conducted in July, show a moderate decline since May. Inflation expectations declined from 6.7% and 6.4% in 2016 and 2017 to 6.6% and 6.1%. The yield differential between inflation-linked bonds and conventional bonds, that is, break-even inflation expectations, declined across all maturities but remained elevated. The global economic outlook has been influenced by the outcome of the UK referendum. The financial markets displayed a high degree of volatility in the immediate aftermath of the outcome, but have stabilized to some extent since then. Nevertheless, the longer-term real impacts are expected to be negative for global growth, particularly for the UK and Europe, as investment decisions are put on hold during the transition period. The high degree of uncertainty is expected to persist for some time, as the magnitude of this slowdown is still unclear and is dependent on the nature and speed of UK's disengagement. Since the referendum, global growth forecasts have generally been revised down. The outlook for emerging markets has remained relatively subdued, with further downside risks in Turkey following the recent coup attempt and terrorist attacks. Recent outcomes in China indicate some improvement in the growth prospects in response to government stimulus packages, and this has underpinned a stabilization and moderate upward trend in commodity prices. The IMF growth forecasts released earlier this week have revised sub-Saharan African growth downwards. The region has been negatively impacted by lower commodity prices and severe drought in some parts. Inflation in the advanced economies remain low and still generally below target. The Brexit vote has also modified expectations regarding monetary policy in these economies. Although the Bank of England kept policy rates on hold at its most recent meeting, expectations are for a reduction in the policy rate in the near future, with the prospect of a resumption of quantitative easing. Markets are now expecting the US policy rate to remain unchanged for some time. At the same time, the highly accommodative monetary policy stances of the ECB and the Bank of Japan are expected to persist, with the possibility of additional stimulus. These developments have reinforced the global search for yield, as yield curves flattened across major advanced economy markets. The number of government bonds trading with negative yields increased further. This has provided additional impetus to renewed capital flows to emerging markets observed since earlier this year. While these flows are expected to persist, they remain sensitive to changes in expectations regarding US monetary policy and general global risk perceptions. The recent volatility experienced by the rand exchange rate has been driven mainly by external factors and changes in global risk perceptions. Although the rand depreciated sharply in the immediate aftermath of the referendum, it has reversed these losses and more so against the British pound. Since the previous meeting of the MPC, the rand has traded in a range of 15 rands 80 and 14 rands 22 cents against the US dollar, and has appreciated by 11% against the US dollar, by 12.9% against the euro, and by 23% against sterling. On a trade-weighted basis, the rand has appreciated by 12.2%. The rand has been supported by the global search for yield. There was a sharp increase in non-resident inflows to the domestic bond and equity markets in June and July. Since the beginning of June, net purchases by non-residents of 107.3 billion rands have been recorded. The rand also responded positively to the improvement in commodity prices and the unexpectedly large trade surplus recorded in May, which followed a small surplus in April. Despite this recent strength, the rand remains vulnerable to possible risk of global scenarios, changes in US monetary policy expectations, and domestic concerns, including the possibility of ratings downgrades later in the year. The domestic economic growth outlook remains extremely challenging following the contraction in GDP in the first quarter of this year. Although this is anticipated to have been the low point of the cycle, the recovery is expected to be weak. The bank's latest forecast is for 0% growth in 2016 compared with 0.6% previously. Growth rates of 1.1% and 1.5% are forecast for the next 2 years, down from 1.3% and 1.7% previously. The bank's estimate of potential output has been revised down marginally from 1.4% in 2016, rising to 1.7% in 2018. The growth outlook is corroborated by the persistent negative trend in the bank's leading indicator of economic activity. Business confidence remains low, with the RMB BER business confidence indicator falling to its lowest level since 2009 in the second quarter of this year. Recent economic data suggests that positive growth was recorded in the second quarter, with the mining and manufacturing sectors expected to add positively to growth. The more positive trend in manufacturing is consistent with the Barclays PMI, which has been above the neutral 50 level since March. The BER Manufacturing Confidence Index also improved, but still remains at low levels. The real value of building plans passed is indicative of some improvement in the sector, particularly with respect to residential construction. However, it is not reflected in the FNB BER Building Confidence Index, which declined further in the second quarter. Underlying the negative performance of the economy during the first quarter was the sharp contraction in growth in gross fixed capital formation for the second consecutive quarter by both the private sector and general government. These trends have contributed to the persistence of high rates of unemployment in the economy. Although formal non-agricultural employment increased in the first quarter of 2016, this was largely due to temporary employment opportunities created by the Independent Electoral Commission. By contrast, private sector employment contracted during the first quarter. Growth in consumption expenditure by households also contracted in the first quarter, with a sharp slowdown in expenditure on durable goods in particular. The FNB BER Consumer Confidence Index declined in the second quarter to low levels following a moderate improvement in the previous quarter. The BER Retail Confidence Index also declined sharply in the second quarter. Whilst new vehicle sales remained weak, vehicle exports recorded strong growth in the second quarter. Despite the surprise increase in retail and wholesale trade sales in May, consumption expenditure by households is expected to remain subdued given the low consumer confidence, high debt levels, rising costs of debt servicing, and slow employment growth. Consumption expenditure has been further constrained by the absence of significant wealth effects owing to the weak performance of asset markets, particularly the housing market. Credit extension to households also remains weak with negative real rates of growth. Average wage growth has remained relatively stable, but there are risks of increases in excess of inflation and productivity gains. There are as yet no clear signs of a recovery in the agricultural sector, and food price inflation is expected to remain elevated for some time. The bank expects food price inflation to peak at 12.6% during the final quarter of this year. There are some encouraging signs of moderation in some food categories at both the producer and consumer price levels, and future prices of grains have declined markedly. Should food prices stabilize or decline in the coming months, there is the potential for significant downside base effects next year. Exchange rate developments will also be critical in this respect, as will global food prices, which have reversed their recent negative trend. Despite supply disruptions and curtailments by a number of producers, the price of Brent crude oil has mostly traded within a band of $45 and $50 since the previous meeting of the MPC. The bank's model assumes a very moderate upward trend in oil prices over the forecast period, but there may be a degree of downside risk in the short term, with some upside risk in the outer period as global demand recovers. The domestic petrol price increased by a cumulative 60 cents per litre in the past 2 months due to both the exchange rate and international oil prices. However, the recent appreciation of the rand, coupled with a lower average oil price, has resulted in a substantial over-recovery in the petrol price, and a sizable reduction in retail prices is expected in August. The Monetary Policy Committee remains concerned about the weak economic growth outlook and the medium-term inflation trajectory, which remains outside the target range of 3 to 6% until the second half of next year. Nevertheless, there have been some improvements in the near-term inflation prospects following successive downside surprises. This is also the case for core inflation, where the expected breach of the upper end of the target range is now less protracted. Whilst the risks to the inflation forecast are assessed to remain on the upside, these risks have moderated somewhat. Global uncertainties appear to have delayed monetary policy tightening in advanced economies. The impact of the more appreciated rand exchange rate on the inflation outlook will depend to a large extent on whether the exchange rate is sustained at these stronger levels. Current exchange rate levels are stronger than those implicit in the forecast, providing some buffer to the projections. The rand remains sensitive to both domestic and external developments, and the recent trends can be quickly reversed. The outlook is clouded by uncertainty surrounding the longer-term market and global growth implications of Brexit. The implications for the rand and domestic growth and ultimately inflation could vary quite significantly depending on which scenario plays out. A weaker global growth scenario could also imply that there may be a degree of downside risk to the international oil price assumption, which was adjusted upwards. A combination of a stronger exchange rate, and subdued international oil prices would have a favorable impact on domestic petrol prices in the coming months. However, the committee assesses the longer-term risk to this assumption to be on the upside, as global growth and oil demand are expected to recover. Food prices remain an upside risk in the near term. There could, however, be a sharp decline in agricultural prices next year should favorable weather patterns transpire as forecast. The absence of demand pressures and weak consumption expenditure growth may also contribute to downside risks. Whilst the committee remains concerned about the overall inflation trajectory, the assessment of the balance of risks to the inflation outlook and the weak domestic economy has provided some room to delay further tightening of monetary policy stance for now. Accordingly, the MPC has unanimously decided to keep the repurchase rate at 7% per annum. The MPC is aware that some of the favorable factors that contributed to this decision could reverse quickly and remains ready to react appropriately to any significant change in the inflation outlook. So at this stage, let's turn to the questions. And as usual, please identify yourself and the media house from which you come from. And this distinguished panel here will deal with your questions. Right here in the front.
Thank you, Governor. I don't think you mentioned whether the vote, what the split in the vote was, and was it unanimous?
Yes, it was.
Okay, I thought so. And your downward growth revisions are pretty much in line with many other analysts and institutions, but 0% this year really is not good. Is there any risk at all that this could slip into a contraction? Thank
you. The back row. Oh, Hillary.
Governor, was there any discussion of a cut? I ask because certainly some economists have been starting to talk about when the first cut will be, and along with that, is there any possibility that this is the end of the hiking cycle?
At the back. She asked your questions. Oh, Hillary. Is that it? Growth at 0%, yeah. It is a significant revision. Could we slip into a contraction? At this stage, based on the data we have, we do not think so. But it is still a risk, as we spell out that the risks are on the downside. But just to give you a picture, after the contraction in the first quarter of this year, to achieve 0% growth this year would require growth of between 0.8 and 1% for each one of the remaining quarters. For us to achieve growth that we had at the previous MPC, which was 0.6, we would need to grow by between 2.1 and 2.5% for every one of the remaining quarters. So that tells you that the starting point, which was the contraction in the first quarter, has actually had a significant impact on the growth outlook. Hillary, was there any discussion of a cut? Well, when you go into that meeting, there are always three scenarios that could. It's either there is going to be a cut, a hold, or a hike. After an analysis of the data and a thorough discussion, I can tell you that there was no discussion of a hike or a cut. That's why we were unanimous about keeping the thing on hold. That as it may be, bear in mind what we are saying in the statement, that the risks to the inflation outlook remain on the upside. And should any of these disinflationary factors that had impacted on our decision today change or reverse, the MPC will react appropriately based on the data that would be coming our way. So we still remain data dependent, and as we say in the statement, that we felt that the recent developments and the outlook going forward had necessitated or had created some room for us to press the pause button on the hiking cycle. Yes, sir.
Afternoon, Governor. Foneko from Reuters News. In the speech towards the end, you say that the RAND remains sensitive to external and local developments. In terms of those local developments, can you go into a bit more detail into what those local developments are? Are they purely economic developments, or are they outside the realm of economics? Thanks.
Yes, ma'am. Funeka didn't steal your question.
I'm Khalang Bata from Bloomberg, Governor. Given that you've said inflation has surprised over the past months on the downside, and we had the gaining of the exchange rate, was there not enough room in the MPC's view to maybe cut at this point in time rather than pause? And also, just to reiterate a question that's been asked before, are we still in a rate hiking cycle, or did you choose to pause because we've reached the end of that?
Hillary?
Hillary Jaffe, Business Day. I forgot to say last time. Governor, when last was the committee unanimous in its decision?
You are testing me. The first time we had disclosed the debates that had taken place and in which direction people preferred the rates to go was in November 2014. There might have been one or two other unanimous decisions, but we can always go back and check into the record. I do write them in a little book like this, but I brought the one for this year. I didn't bring the one for last year. And then question about was there a question of cutting and not holding? Well, I think that I had been very clear that when getting into that meeting, in the deliberations, it was very clear that it was neither a cut nor a hike, which is why we ended up with a unanimous decision. I think that your question that you're raising of saying why couldn't you have cut here? The thing about the interest rate path is that there's got to be certainty about where you are going. You can't chop and change as you are going along. And that is why data becomes so important. We have to constantly be looking at the data, and most of this data will be looking backwards. And that is why we have got clever men and women in our research department who take this data and try to look forward and say, based on this data, this is what we see is going to evolve, and that we were able to base our views on a forward-looking basis rather than on a backward-looking basis. What are the sensitivities? Well, currencies react to all sorts of things. In the main, one would have preferred that exchange rates are driven purely by fundamentals. And those fundamentals would include political developments and economic developments, what data comes out and whether that data is positive or negative would impact on the exchange rate. But most instances, currencies react to sentiment, and sometimes that sentiment might not even be emanating from here. Sometimes the sentiment might not even be real, but currency markets react to all of those. Before I come here, there's a new hand at the back.
Governor Arabile Kumete from Bloomberg. I'll ask a question that's sort of been asked already, but I just need to reiterate if there's a clear answer. Given the data you have we come to the end of the rate hiking cycle?
We have pressed the pause button on the hiking cycle. Miriam.
Mariam Issa from Times Media. I also forgot to introduce myself the first time. The first question I have is pretty simple. I was just wondering whether you'd had a chance or whether you had gotten around to looking at the possible implications of a sugar tax on inflation. And then the second question is, I was a little bit surprised that you said the inflation risk was still to the upside, even though this had moderated, given what we've seen happen in the currency. And I think you also said something about your currency forecasts being a little bit bearish, and therefore the inflation outlook may improve. I'm just wanting to check on that. Do you think is there a good chance the inflation outlook will improve going forward?
Governor, a question from Danily Masia of Deutsche Bank. If the rand was sustained at current levels, what impacts would this make on your inflation forecasts?
Okay, gentlemen, you know I don't take sugar in my tea. I am going to ask one of you to deal with the impact of the sugar tax. And any volunteer on the exchange rate? Brian, I volunteer you. Rashad, you'll deal with the sugar. Whilst you are thinking about the sugar, Brian, deal with the exchange rate. Oh, his sugar levels are high enough.
Look, I guess I'm not going to answer your question because I'll be kind of meandering about. But I think there is an important issue about the sugar tax. So whatever the magnitude, I think that we should think of the sugar tax like a VAT. You know, it doesn't affect the trajectory of inflation. It has a one-off increase depending on what the tax is in the following year, and it runs through the index numbers for 24 months. So I think that the critical thing is that whatever the impact of the tax is, that we, from a monetary policy point of view, simply cannot look at an increase in tax as the basis for the inflation trajectory. And I think that's the critical point.
Right?
If I could just add to that, I think the modelling team has done some preliminary work on that, and the impact is in the order of 0.1 percentage points, so very small. As far as the impact of the exchange rate is concerned, I think it's always a difficult, given the volatility of the exchange rate, it's always difficult to know where to pitch the exchange rate in terms of the assumptions. As we said in the statement last time and this time, in the previous meeting, the exchange rate prevailing at the time was above what we had in our forecast. This time it's below what we have in our forecast. Clearly, if the exchange rate had to persist at current levels for some time, it would change the starting point for the forecast and would have a favourable impact on inflation. But at this stage, we felt, given the volatility, given the uncertainties around these exchange rate movements, we prefer to leave the assumption where it was at the time of the last meeting, because these can move so quickly. So it really depends on the sustainability of the rate at these levels.
Nigel, do you want to add anything?
Thank you, Governor. Let me attempt to answer part of Mariam's question and Halang's question. if we separate the future into two periods, so between now and the third quarter of 2017 and the third quarter of 2017 and beyond, there are certain favorable factors between now and 2017, the third quarter of 2017, which makes the inflation trajectory look better. And so you could argue from that perspective, well, maybe you could cut rates. However, monetary policy is only really effective in about 12 months' time. And when we look at that period from beyond 2017, we still think that there are significant risks to the inflation trajectory. If we take a view beyond 2017, it's unclear what the impact of a resumption in rains will be on food prices. It's unclear how long the currency will sustain at these levels. It's unclear what global oil prices are. And the uncertainties are just too large and, in fact, still very elevated. That's why we have this, I guess, unusual situation in the statement where we say that even though the outlook is favorable in the short term, we still think the risks are tilted to the upside in the medium and longer term. And that's why we did not seriously consider a rate cut.
Fransha?
Thanks, Governor. I just also wish to respond briefly to an aspect of Miriam's question regarding the exchange rate assumption. It's also important that you distill between what is the pass-through assumption in the model, and of course what happens in the economy in terms of pass-through, and there's a whole bunch of factors that weigh in. So the pass-through assumption in the model is based on a very, very long-term assumption regarding pass-through, but of course actual pass-through in the economy varies from time to time, and so that there's a further dimension to that particular issue as well.
Okay. We have got a first-time journalist here in the front.
Thank you, Governor. My name is Rachel Masadza from Springs Girls. I've got two questions for you, Governor. Question number one is based on the Brexit, the exit of Britain from the European Union, and how it impacted on the South African economy, and how it is going to continue impacting on the South African economy besides the impact on the rand. My second question is based on, you spoke about high uncertainty brought about by global and external concerns, like, for instance, the Brexit. I want to find out if the rand continues on its downward path, is there a possibility that the MPC will intervene in the foreign exchange market? If so, does it mean that South Africa will move from free floating exchange rate to managed floating exchange rate in the future? Thank you.
Thank you. Is there any other question at the back there?
Yes, Governor. A question from Gift Dlamini from Instinctive. How significant is the country's pass-through rate?
How significant? That is exactly what Deputy Governor Groep has just dealt with. So, yes, sir. Mfuneko.
This is probably directed to Deputy Governor Naidu.
No, you direct them to me.
Do I direct them to you? Okay. Then to you, Governor. I want to ask, how concerned are you about consumer debt levels? Are you perhaps seeing a move to unsecured debt, unsecured lending, and how much of that was discussed during the MPC's deliberations? Thanks.
Hilary?
I don't know if I'm allowed one non-monetary policy question.
Shall we
Depends on
deal
the
with the
questions.
monetary policy questions and then we can come to that one? Miriam?
Okay, going back to the pass-through, could you remind us what it is numerically, how you, where you put it at the moment, and if demand remains as poor as it is now and investment as poor as it is now, is it likely to decline further?
Okay. Deputy Governor Naidu, I am just a messenger on consumer debt, so you can.
Consumer debt has not been going up significantly. I mean, it has not been falling sharply either. Consumer debt's been at fairly high levels. You have two things going on. On the one hand, you've got very little growth in household income and disposable income. And on the other hand, you've got very weak credit extension. So there's not been a significant change in household indebtedness. The SARB has three broad mandates. We worry about financial stability, we worry about price stability, and we worry about the stability of individual institutions. In the Monetary Policy Committee per se, we don't discuss the impact of high household indebtedness, or let me rephrase that, we don't discuss what the likely impact of interest rate cuts or hikes are likely to be on household indebtedness. We do discuss that in the Financial Stability Committee, and we take a broader view of financial stability risks. So we are concerned about household indebtedness, but it's not something that we will use monetary policy solely to fix.
Okay. Group, we want to deal with the pass-through again?
Yes. Miriam, we have sort of previously disclosed that the assumption regarding pass-through is about 20%. I think one of the big issues within central banks is the debate regarding actual pass-through, which is far more muted than historical trends would suggest. So we are seeing weaker pass-through, but one of the big questions is it a temporary phenomena? Do you have a step change at some point in time, etc.? And bear in mind, pass-through, things such as potential, such as output gap, these are virtually invisible numbers to measure. There's a whole bunch of factors that may have an impact in terms of when you do the calculations. For example, what's the starting point, what the type of filters that you apply to it. So it is a fairly complex issue. What we are seeing is that pass-through is more muted, but the assumption in the model is that we use 20%. But of course, there's a whole bunch of academics and private analysts that have published studies in terms of what they see pass-throughs, and there's quite a wide range in terms of what those estimations are.
You have nothing at the back, right? Okay, thank you very much. Ms. Rachel, the Brexit, I mean, we have gone to lengths about the impact of Brexit on the global economy. And you said that besides the rand, what else? And you are going to have to look at two things. One is that the UK is a destination of 4% of our exports. So that is a one channel. 4% is not going to be breaking the bank, and it doesn't mean that the fact that they have exited the euro area, then the European Union, excuse me, that you will stop trading with them. And that's why we kept on emphasizing that over the long term, these things are uncertain. There is a trade agreement with the European Union that could suggest that when the UK eventually leaves the European Union, there might have to be another trade agreement with the UK. There are a lot of these agreements to be negotiated, and it just makes the issue complex. Now, I just wanted to make sure, when you said the rand go down, did you mean going down from 16 rands to 14 rands, or going down from 14 rands to 16 rand? Which one?
Governor, I meant the rand depreciating, which means losing value.
The rand depreciating, yes, meaning losing value.
Mm.
Okay. Like we had said previously, we do watch what is happening in the foreign exchange market because it's a very important price in the economy. But we don't target the exchange rate. And as a matter of course, we have got a policy of pursuing a floating exchange rate policy. And because we have got a floating exchange rate policy, it means that the value of the rand is determined in the foreign exchange market by forces of demand and supply. And we had previously tried to intervene in the rand. We came out second best, cost the country a lot of money, and it was a very expensive lesson. And what we then had spelled out was that we will allow the rand to find its value in the market. However, should there be indications that there is a dislocation of markets, we might consider getting involved to make sure that there continues to be proper functioning of the market. So if we get involved, we will not get involved because we are trying to influence the value or the level of the exchange rate. It is something that central banks are not particularly good at. The last question is for Hillary, from Hillary. Hillary, what was your question?
Last week this is an exchange control question. Last week you published a set of rules for the exchange control amnesty, which is due to start in October. And I wondered if you had any sort of estimate about how much there was in assets out there that could potentially be disclosed. And also, have you lately seen any anecdotal evidence? We hear anecdotal evidence that, given the uncertainty and the very low growth in South Africa, people have been sort of taking quite a lot of money out of the country, individuals that is. Have you seen any evidence of that?
Yes, the thing about amnesties is that you do them because you had figured out that it is not possible for you to establish what is actually out there. And so by offering an amnesty, you hope that then people do come back. The amnesty of 2002-03, I think that there were assets declared in excess of 76 billion rands that South Africans had offshore. We have gone out with this amnesty proposal, and we are going to have to see what comes our way. In terms of money, people taking money out, well, I mean, it will be a very interesting thing that when the rand was at 6 rand or at 8 rand, people were not taking the money out when it was cheaper to take the money out. That they would choose to take the money out when it is particularly expensive to take the money out. But growth of has slowed down in South Africa. We think that we will come at 0.0 this year. So you take your money out and you take it where and at what rate are they growing? Well, indications are that a lot of them are contracting. And you take your money, what do? Buy German government bonds? You will have to pay the German governments in order for them to sell you the bonds, because they are at negative yields, at least up to the 10-year level. And there is a lot of negative bond yields out there. So it's not a very pretty picture out there, but we haven't seen any pent-up demand. I don't know, Kumbena, unless you have seen anything from financial surveillance, but we have not seen anything significant.
Governor, what we have seen and what we're quite excited about is that from 2017, 2018, there's an international tax sharing agreement that South Africa has signed, where foreign jurisdictions, including what are traditionally called tax havens, will share tax data with our tax authorities. And this is very broad, and it's quite exciting. So there are thousands of South Africans who have money abroad that either they took out of the country illegally or they didn't pay their tax on. And it is highly likely that we'll find those people out. And so they are coming forward and they're saying, can I get amnesty? Can I legitimize these flows? So we're quite excited about it. And we've had a lot of attention. Of course, the amnesty only opens later this year. But we have had lots of interest. We think that we'll get not just a fair bit of revenue, but a fair bit of earnings or assets regularized.
So there is a last question at the back. I hope it is not one that you have already answered.
No, it's not, Governor. A question from Peter Montalto of Nomura. Governor, can you please comment on the spread between the base rate and 3M JIBAR? Is this doing additional tightening of monetary conditions for you?
I will ask Mr. Minere to respond to that one.
No, I couldn't give him a response now. I'll have to just check the numbers and I'll get back to him. I haven't got the details with me now.
I thought you said you don't have questions anymore. Those are the last two hands at the back.
Governor Xolo Potelo from Bloomberg News. I'm just interested in your perception of why foreign investors are buying South African stocks at the pace that they are. We're in a 34th day of inflows today. And it seems to me in a world of, expected low global growth, you wouldn't be thinking people are piling into stocks. Could you just why you guys think that's happening?
I'm Khalang Bata from Bloomberg again. We're going into the wage negotiations in the mining industry later this year. Manufacturing has already started. How concerned are you about above inflation wage increases, especially given that inflation came in at 6.3% in June, which is outside the target band?
Okay. We have previously commented about wage increases. And you would notice that we had been very careful. We say that wage increases must be in line with productivity gains. So for as long as you have got wages growing and are in line with productivity gains or are below productivity gains, the economy remains competitive. However, if they are running ahead of productivity gains, it brings all sorts of dynamics, including the possibility of inflation beginning to rise. So that would be a concern. So you can't take an attitude that says that people can't have wage increases. The point here is wage increases have to be related to productivity gains. And I do not understand why South Africans would like to complain that foreigners are bringing their money here. It's not a complaint. Okay. No, we're also trying to understand the key drivers. And we try to go into some of those drivers in the statement. We're saying the fact that the markets are starting to price in that U.S. policy rate increases could be delayed. Then we are having a situation where investors are feeling, okay, I could go and pursue these better returns elsewhere. That's the first aspect. The second aspect is that many pension funds in the advanced economies are actually underfunded. And the underfunding came as a result of historically low interest rates, and many of the pension funds are struggling to meet their commitments. And as such, they are looking for assets that are yielding better returns. And those of these assets that are yielding better returns are in the emerging market space, and South Africa happens to be one such. Third is that with the increasing number of bond yields that are negative in the advanced economies, the money has to get some return somewhere. And on a risk-adjusted basis, they would then make a call and say, where do I take my investment to? It is welcome that we are having a return of the capital flows, but we must understand that these capital flows are volatile and they depend on global sentiment. And that is why things that impact on global risk sentiment become crucial, and we have to constantly watch them because they have got implications for capital flows. My student, before, yeah?
I think one point that one might add with regard to the flows, in addition to these sort of strategies for searching yield, is that part of it may also constitute a correction. You would recall that quite a number of people had been positioning themselves for possible downgrades in June, and in the absence of that happening, some of those flows may have been restored as part of a corrective move.
Okay. The last word goes to the student.
Rena Sevigman from Springs Girls. I'd just like to ask a question. What caused the surplus in the first quarters of this year, also considering the fact that there was a depreciation in the rand?
I'm going to ask teacher Rachel to sort you out. The only reason you generate a surplus is because you have exported more than what you have imported. So what we have also seen here is that there had been a contraction in our imports whilst our exports rose faster, and that had generated that trade surplus. Thank you. That concludes the proceedings of today. Thank you very much. We will see you in September.